Hello, and thank you for joining us today for Frost & Sullivan's latest webinar. Today's event is titled The 2019 Global Economic Outlook. My name is Anna, and I oversee Frost & Sullivan's Growth, Innovation, and Leadership briefings. Our presenters today are Arup Zushi, Global President and Managing Partner, Craig Parker, Research Director, and Neha Anna Thomas, Senior Economist here at Frost & Sullivan. With that, I would now like to hand the presentation over to Arup.
Thank you, Anna. Good morning, good afternoon, good evening, everybody. First, I'd like to wish everyone a very happy new year, and I want to thank you for taking the time to be part of our session today. It's a very, very interesting session. It's being developed by our entire team, and of course, I'm taking the opportunity and the liberty to present it on their behalf. So let me go to the next slide and give a little bit of a preview of what you will be seeing in today's presentation. But before we talk about 2019, I think it's very important to kind of quickly recap what 2018 looked like at the beginning and how did we finish 2018, because many things that we saw in 2018 will actually flow into 2019 with some positive impact and obviously some negative impact, thereby potentially derailing the overall economic growth worldwide. So as many of you know, when we started 2018, we were significantly more optimistic. We were expecting the GDP growth rate worldwide to be a lot more higher than what we finally ended up seeing. And we know many things that happened in the last 12 months that actually created the economic tensions between various regions of the world, between specific countries in the world. I think last not but the least, major changes in the monetary policy also had an impact on the overall economic performance, including, of course, the oil prices that also changed over the last 12 months. I think the trade war between China and the United States, two of the largest economies in the world, was quite significant. It derailed, it slowed down, and had significant impact, not just between the two countries, but there was a trickle effect that went to other parts of the world as well. And what we also saw in the U.S., for example, for rate hikes, and whenever you have rate hikes, it just derails the market overall. We've seen a lot of pressure in the market, especially in the European side with Brexit, with deals trying to be worked out between the UK and the European Union. And obviously many things are still up in the air, and that remained significantly up in the air in 2018, which also had a bit of a negative impact on the market. We also saw the oil prices the oil prices increased from $54 per barrel to almost $71 per barrel, and that also had some impact. And of course, the U.S. sanctions on Iran also had some significant impact. So what we saw when we started the year and what we saw towards the end of the year were two different stories, and that's why we had a much softer GDP compared to what we had initially estimated. And the final numbers are still being reconciled, but we see it around 3.7% in 2018, and the impact of that will certainly be felt in 2019, which we'll cover in a second. So Anna, would you mind going to the next slide, please? So what we are going to see in 2019, unfortunately, is a slightly weakened system. We are going to see a GDP growth slightly less than what we saw in 2018, probably in the 3.5% rate. And what we are also going to see is that if this trade war continues, which hopefully gets settled, we may see the potential GDP drop even more, because there are many other factors that are likely to pull back this GDP performance, not just between US and China, but also in Europe with the UK and the European Union for the Brexit, and of course in other parts of the world like Latin America, where we are seeing some shifts, both on the economic side as well as on the political side. And I think those things will also have an impact on the overall performance of countries within that region as well. From an oil standpoint, we do believe that the price of the barrel will settle somewhere in the $60 to $61 range, and the oil supply will more or less be balanced. So there is no major risk because of oil supply, but certainly we do see that the OPEC will not necessarily carry through the production cost that they have seen in the past. So all in all, as a summary, I will say that the prediction for 2019 is a softer GDP growth, and so we have to be prepared for a slowdown overall in the economy. Anna, next slide, please. If you look at some of the key elements, I touched on this very early. The UK-EU trade system that needs to come into place, I think that has to be ratified before March 29th. If that happens, we do see some significant movement. The business will be as usual, but if that doesn't ratify, we do see some major upheavals in that part of the world. When you look at Latin America, for example, and this is true for all the emerging markets, with the rate hikes in the U.S., we saw currencies across all the emerging markets drop, including countries like Argentina, Turkey, India. These are big economies, and all of them saw a drop in their borrowing ability as well as in their currencies. And so that certainly destabilized the market to some extent. Obviously, there's political turmoil. This happens in every part of the world, but we saw some major political issues that have emerged in 2018, some of which are continuing in 2019. The effects of the 2018 will be felt in 2019. One is, of course, the Saudi killing of the journalist, the involvement of and the changes in Venezuela, for example. Even a country like India faces a risk of a potential change in government. It is possible there could be a weak coalition government. And of course, the mother of all political turmoils is the U.S. government shutdown, which definitely had a slowdown in a negative impact on the marketplace as we saw in the last few weeks. And the next slide, please. So very quickly, if you look at regionally, and we'll take a much deeper dive with my colleagues very shortly. In North America, we will see the general slowdown happening. We will see some intensified trade wars that U.S. will potentially have with not just China, but with other parts of the world as well. We will see, hopefully, rates steady now that we have Fed saying that they will probably not increase. So we will see some stability happening, and this will be very important to make sure that the economy doesn't dip further in North America. In Latin America, we see uneven growth. We see countries like Brazil, Colombia, and Mexico seeing growth, but we do see slowdown in economies like Venezuela and Argentina. So it will be a mixed bag, but this is something that we'll have to be prepared to deal with in Latin America. Africa is definitely the bright spot, and you will see great momentum continuing into Africa across the world, across the region. So I do believe that the upcoming elections in a country like Nigeria will be something that we have to be watching out for, and that can potentially derail a bit of economic activity in Africa. But all in all, Africa is certainly the bright spot for 2019. Let's go to the next slide, Anna. As you look at some of the other parts of the world, Europe, we will see a mixed bag. We'll see Germany and France holding steady, but we definitely see a growth slowdown that is happening in Italy, UK, and of course, Russia. Brexit will play a very, very important role. If we have a good Brexit, if everything gets settled, we do see some good movements in the UK economy. Otherwise, we do see further slowdown in that part of the world as well. As far as Middle East is concerned, I think there is a general slowdown that we are going to experience in 2019. The VAT system has been introduced. That has made it simple, but cost of goods has certainly gone up in that part of the world, which is exactly one of the key benefits that businesses had in the Middle East. But we're going to see the impact of VAT coming up very shortly. But the government recognizes it, and the government is spending a lot of money in infrastructure and other projects to make sure that the businesses don't suffer. Asia Pac, which we all know now is a very, very important part of global economy as a region, with two major countries like India and China. We are going to see slowdown in China. We won't see the big growth like we used to see in the past. At the same time, the quantum of growth you will see in China will still be quite substantial, because the 5-6% growth in China is much larger than growth in many other countries. We will see strong growth in India. I think their fiscal and monetary policies are quite stable. We saw some negative impact because of demonetization, etc. But I think those are now behind us, so we'll see some good movement in that part of the world. And we do believe that Chinese government will put a lot more emphasis on infrastructure, so that will hopefully offset some of the general slowdown that we will see. So that's a quick overview of what I see in 2019, but obviously it's always a mixed bag, and you'll get some more insight as we go along this presentation. Thank you, Anna. Over to you.
Good morning, good afternoon, and good evening, everyone. Thank you, Arup, for the insights. And over the next couple of slides, we will be covering some of the key global economic trends that we're seeing in greater detail. If we could move over to the next slide. Great. So these slides will help you better understand our scenario-based modeling approach and give you a little more information into the data through the charts and the trend lines that you will see. So we've taken a scenario-based, this slide obviously gives you insights into the global GDP growth outlook, and we've taken a scenario-based approach based on trade wars. There are obviously various scenarios that could play out. And you may ask why trade wars. There are various scenarios that we could also see happening with respect to factors such as interest rates or oil prices. We see that the global economic outlook really hinges to a very large extent on trade wars. Why is this? It's not only affecting countries such as US and China directly, it's affecting export powerhouses such as Japan and Germany, and it's of course affecting other markets that are supplying to these countries. So the entire world really seems to have come under pressure from trade wars, which is why we have developed scenario-based projections for GDP growth and trade. So the chart that you see on the left-hand side of this slide provides GDP growth analysis based on our baseline assumption that is a continuation scenario. So what this scenario essentially means is that additional tariffs from 2018 will continue as is in 2019. Now this particular scenario plays out, we're expecting world GDP growth, like Arup mentioned, to slow down from 3.7% in 2018 to 3.5% in 2019. So businesses essentially have to brace for a period of slowdown in 2019. Now moving on to the other scenarios, there's of course the intensification scenario or the escalation scenario that we're all hearing about in the news. So what this particular scenario means is that we expect growth to slow down to 3.3% or lesser even. It really depends on what plays out, whether the US imposes additional tariffs on Chinese imports that are not covered as yet, whether it raises the level of additional tariffs, or whether, for example, 25% automotive import tariffs come into play. So it really depends on whether it's a combination or the imposition of all A, B, and C factors. So growth could slow down to 3.3% or even lesser. And the last one, of course, is the conclusion scenario, that is the removal of all additional tariffs and refrain from new additional tariffs. But even under this scenario, we're expecting growth to slow down to 3.6%. The reason being that even if tariffs are removed, we're not expecting to see this until March 2019 or later. The reason being that the US and China obviously are in the midst of a truce. So it's only from March 1st of 2019 that we can potentially expect a change in the trade war situation. Moving on to the next slide. So the next slide gives you an explanation, a scenario-based approach to the trade outlook. Again, you have trade growth under the scenarios approach, and we're expecting under a continued scenario for trade growth to slow down to 3.2%. The graph, of course, offers evidence as to how global trade growth has already been slowing. Now, in terms of the impact of the trade wars, taking the case of the US economy, for example, there have been positive and negative effects. On the positive side, for example, there has been evidence of how higher import tariffs have helped the resurgence of local manufacturing to an extent. But on the flip side, we are seeing that businesses and consumers are having to deal with the effects of a lot of these higher tariffs. And in terms of mitigation strategies for these trade wars, we're seeing that businesses are trying to deal with these higher import tariffs by either passing the cost to the consumers, even pursuing layoffs or relocating production. But at the same time, for example, when there's a slowdown being witnessed in China, what we're seeing is growth opportunities being created across economies such as Vietnam and Thailand. A lot of investors are renewing their focus into these countries given that China is heavily coming under tariffs. So while there are negative effects happening, some growth opportunities being created as well. Let's move on to the next slide, which delves into our oil price analysis into greater detail. So if you turn your attention to the chart, you will see that oil prices picked up from about, Brent crude oil prices picked up from about $54 per barrel to $71 per barrel in 2018, which is quite a large jump. So these are annual average prices, and through most of 2018, oil prices rose, barring Q4 2018, of course. In Q4 of 2018, what we saw was a little bit of a reversal because of higher production from countries such as US and Russia and the extension of Iran's sanction waivers. So in Q4, mostly in December of 2018, we saw oil prices moving down to about the $60 mark. And the outlook for 2019 is that of almost balanced demand and supply, because of which we expect 2019 oil prices to sort of hover at the $60 mark range. Now, why are we expecting balanced demand and supply? On the demand side, if you look at it, demand growth, of course, is expected to undergo some slowdown, obviously in the light of the world economic slowdown. And on the supply side, we're seeing OPEC production cuts that are actually happening, and then there's higher US production that's happening. So overall, the picture is for a balanced one. Of course, if the OPEC doesn't go through with the production cuts as announced, we could expect a much sharper decline in oil prices in 2019. Moving on to the next slide. So for the next section, Craig and I will be covering the 2019 Regional Economic Outlook Analysis for 6 key regions, providing you insight into GDP growth trends and key economic developments and their impact. And I will be starting with North America on the next slide. If we could move to the next slide, please, for US and Canada. Right. So the US, this particular slide shows you an analysis of the GDP growth. So for each country, you have bar charts or data for their 2017, 2018, and 2019 GDP growth rates. So we're largely expecting to see a growth decline for both the economies in 2019. US, in fact, recorded a very strong year of growth in 2018 in the light of factors such as tax cuts acting as a stimulus to the economy. Moving over into 2019, of course, higher tariffs are expected to bite into the economic growth, and interest rates are expected to be higher. As Arup had mentioned, we don't expect to see rate hikes, but they're still higher compared to the last couple of years. And of course, this effect from the fiscal stimulus fades away. And even with respect to Canada, interest rates again are expected to be a growth restraint, and we're also expecting to see somewhat a slowdown in the country's key housing market in the light of these higher interest rates and a new mortgage stress test. Our next slide analyzes the key economic developments and the impact of the same for the US. So for each of the sections at the bottom, you'll sort of see a call-out box for the overall impact in terms of whether it's positive or negative, indicated by the different colors. So for the North American region, the first major economic development, of course, is that of Nafta, or the North American Free Trade Agreement, which is now being called the USCMA trade deal that's been renegotiated. So a couple of months back, the deal was in fact finalized and signed between the three member countries, US, Mexico, and Canada, which came as a huge sigh of relief for investors and businesses across these regions, because that gives the certainty that their supply chains stay intact. But there's still one major process pending. Ratification of this particular trade deal is pending, and it's expected to happen in H2 of 2019. So if this is ratified, all well and good, we expect to see a resurgence of manufacturing in North America. If it's not ratified, and of course the US pulls out of the Nafta by that time, a lot of uncertainty for the region. Trade wars, of course, like I already mentioned, are sort of biting into the economic growth, with business activity slowing down. And with respect to US Fed rate hikes, obviously these are very important, because US Fed rate hikes are normally followed by rate hikes across the rest of the world, which we saw in 2018. So a couple of weeks back, our projection was that of 2 interest rate hikes, with the Fed expected to continue its monetary tightening cycle. But now with sluggish inflation data and the possibility of another government shutdown that could possibly bite into the US economy, and of course the impact of trade wars, we're expecting rates to sort of be held steady in 2019. So we don't expect to see too much upward pressure on, your loan rates for businesses in 2019. With that, we come to the end of the North America analysis. I will now hand it over to Craig.
Thank you, Naya. Firstly, we'll look at Latin America and look at the two larger economies. We see that in 2018, Brazil made a mild recovery, expanding by 1.5% from the 1% in 2017. The uptick in growth was supported by consumption and increased fixed investment, but there were challenges, however, with higher than expected unemployment and output gaps in the economy. Now, if we move forward, we see that the new president, Bolsonaro, has an uphill battle to place Brazil on a steady growth path. But he's put together a well-respected team to improve the fiscal state of the economy, because not only is the government debt high, but households are also under growing pressure with increased debt servicing costs in the economy. But with the right measures and positive sentiment increasing in the first half of 2019, we do see that GDP growth will be increasing to 2% in the coming year. For Mexico, 2018 was an interesting year, having to weather the uncertainty around trade negotiations with the US and Canada. But despite the uncertainty, GDP grew by 2.1% in 2018, which was slightly higher than the 2% in 2017. The tariff restrictions, however, did result in some exchange rate volatility, but through the reductions in trade and limiting investor uncertainty. Now, looking forward, the government will have to limit public expenditure due to the high sovereign debt, and the new president has already done so. One example is he cancelled the 13 billion airport project that was going to start. So for 2019, we see the growth expectations increase slightly to about 2.2%, and this is mainly due to stronger household expenditure. However, there are obviously downside risks with trade uncertainty that will remain. So if we move to the next slide, we see that Colombia's growth remains as a top performer in Latin America with 2.5% in 2018, which is actually expected to strengthen even further to 3% in 2019. The oil prices served to stabilize the currency in 2018, and into 2019 we do expect more investment into the mining sector, which should improve growth. If we move to Argentina, we see that they witnessed a very challenging 2018 with a sharp devaluation of the currency. The strengthening of the dollar and the inability of the Argentinian government to control inflationary pressure resulted in low investor confidence. We also saw that severe weather impacted the agricultural sector, and this placed even more pressure on GDP growth. Looking forward to 2019, we expect that conditions will improve with new austerity measures and the IMF approving its revised agreement to assist the government. So if we look at the next slide. So far for Latin America, we've looked at the good, we've looked at the bad, and now we turn to Venezuela. For years, mismanagement and a sole reliance on oil and lack of diversification with sanctions have resulted in the economy contracting by 30% from 2013 to 2017, and also a further 18% in 2018. The current turmoil with Maduro fighting to stay in power, and with 19 European nations recognizing Guaido as interim president, has also further worsened the economic outlook for recovery in 2019. Hyperinflation is unfortunately expected and will remain the greatest threat to the economy in the next year, with the inflation expectations reaching 10 million% in the second half of 2019. So now we're going to explore some of the broader economic developments taking place in Latin America in the next slide. In 2018, Brazil updated its policy on the special regime for industrialization of goods destined for exploration, development, and production of oil, natural gas, and other hydrocarbons. This is known as Repetrosped. The revised policy attempts and exempts taxes on raw materials used for domestic production on oil, natural gas, and fluid. It has also exempted and eliminated tax on the local sales of finished product. In July 2018, Brazil's oil exports actually reached an all-time high of 8.1 million tons, and with the revised policy, we can expect this number to actually further increase in 2019. On the negative side, the turmoil in Argentina, one of the largest economies in the region, is highly worrisome. And while most of the emerging market currencies suffered in 2018, the Argentinian peso fell by a whopping 53% against the US dollar. And Argentina has now become the world's second riskiest sovereign borrower. So when we look at that, we can see this might have a ripple effect on the region as the slowdown might continue. We can move to the next slide. Now we move to the Africa region. So we move across the Atlantic and we first look at Tanzania. Growth slowed in 2018 from that in 2017, but it was still quite significant at 6%. One of the key factors that contributed to this decrease was the drop in copper prices, which is obviously one of Tanzania's key exports. If we move forward to 2019, Tanzania is likely to register a strong growth of 6.6%, and this will mainly be driven by government investment and expenditure. The higher expectations of copper and commodity prices in 2019 could further support this growth. In 2018, the government had reduced corporate income tax from 30 to 20%, and this effect is likely to impact and ripple over into 2019 with increases in investment and expansion of the manufacturing sector. Looking at Kenya, we see the growth momentum supported by the expected continuity of the remittance inflow, and we also see a turn in which would obviously fuel domestic consumption demand. So monetary policy is stability will keep inflation at around 5.5%, and fiscal consolidation is expected to continue into 2019, and this should boost investor confidence quite nicely. On the restraint side, Kenya implemented a levy of 8% VAT on fuel, and this could likely increase the burden on consumers, and they're also likely to increase taxes in 2019 to boost government revenue. This could have a negative impact on consumption demand. We also have to obviously recognize the continued threat of terrorist attacks in the country, and this might also have a negative impact on tourism and business travel, which is a good proportion of their GDP. So moving to the next slide. See South Africa. We expect the country to continue to be hampered by slow growth. In 2018, the country grew at a slower pace of 0.8 compared to the 1.3 in 2017. Most of these factors being attributed to the contraction in agricultural and industrial sectors, as well as hampered investment spend. The country is marked with high unemployment and a lot of muted growth in private consumption. And this is mainly due to supply-driven inflationary pressure and significant currency depreciation. Things look slightly better for South Africa in 2019 as the government economic stimulus packages has uplifted the business sentiment, and it is expected to stimulate higher investment. The growing automotive exports are also expected to support the manufacturing sector in general. Now, on the downside, as is the case of most African countries, South Africa is also witnessing growing government debt, which is used to finance budget deficits. And given the rising cost of servicing this debt, this could push inflation a little bit higher in the country. If we look at Nigeria, we see a recovery remaining very slow because it's highly linked to the oil price. Much of the services and manufacturing sectors in the country are restrained by inadequate infrastructure and bottlenecks, so the overall non-oil sector growth will remain subdued. Nigeria's government is either planning to increase government spending on infrastructure, which could contribute to growth in 2019. Unfortunately, this all hangs in the balance due to elections that have been mentioned earlier. So Nigeria is also vulnerable to the US-China trade war, and also, obviously looking at the elections coming in the middle of the year. Now, if we go to the next slide, we just delve into some of the key economic developments that could impact Africa. We see that Africa continues to make positive progress towards the adoption of the African Continental Free Trade Area, which is expected to be ratified by the end of January 2019 by 40 signatories. The interesting point here is that if the deal gets ratified, the free trade area will be activated within a month. Now, this will position Africa as a single regional bloc in the global trade arena. Africa then stands to gain from increases in intra-Africa trade while also attracting foreign investment. We must, however, issue a note of caution as the increases in trade will not happen overnight. There are obviously logistical challenges, infrastructure constraints, bottlenecks, and other challenges across the border that will continue to impact and hamper trade in the real world. If we look at the debt crisis, as we mentioned earlier, for African countries, they've been trapped in this crisis, and countries such as Cameroon, Ghana, Ethiopia, and Zambia are heavily indebted to China, for instance, and an estimated 14% of Africa's debt is owed to China. If the current trend of high capital outflow from emerging markets continues in 2019, then African countries may be at risk of currency depreciation. The ramification of this is obviously higher cost of servicing foreign debt, which obviously is a vicious circle. This would entail higher taxes and upward inflationary pressure in the region and the impact on consumers. Debt and repayment agreements do continue to be a factor that weakens Africa's fiscal outlook. We move to the next slide, Middle East. So if we look at the Middle East region, we see that growth remains precarious, in the outlook for 2019 due to the volatility of oil on the one hand and the intensified geopolitical tensions in the region on the other. So if we look at the Saudi Arabia economy, we see that they've only reported moderate growth of 1.8% in 2019, and this was primarily supported by steady rises in the non-oil activities in the economy and the kingdom's privatization efforts. A part of the growth could likely get nullified by the oil output cut, though, as this was agreed by OPEC. Amongst the constructive efforts of privatization, Saudi Arabia is optimistic about their program and aims to generate as much as $11 billion in non-oil revenue by 2020, even if the recent Aramco's privatization plan is delayed. For Iran, the outlook remains quite somber as the economy stands to face recession this year. The U.S.'s reimposition of sanctions is dragging the country into recession, and the Iranian currency hovering at about 100,000 to the dollar in 2019. This is due to deep recession and obviously slow trade. Oil production will fall by about 1 million barrels a day to 2.8 million in 2019 compared to the 2017 levels, and oil exports will also slide to only 1.2 million barrels a day in 2019 from 2017's average of 2.5 million. If you look at the next slide, Qatar is scheduled, well, it secluded itself from OPEC in January 2019, and the country being a gas export-driven economy. And the economy is also gaining strength as it started mass construction activities, obviously for the FIFA World Cup in 2022. If we look at Turkey, we see that due to strained U.S.-Turkey relationship, followed by additional tariffs that were imposed on Turkish steel and aluminium in the U.S., the lira took a downward spiral. Turkish investors had always relied on cheap foreign debt, most commonly dollar-denominated debt, and they went into a currency crisis. Now, undoubtedly, with a suddenly far weaker Turkish lira, foreign debts are now much harder to be repaid. The interest rate is going to stay high in 2019 in a bid to prevent inflation from rising, which is actually still above 20%. The country might also see an IMF bailout of its local elections in March of this year. Now, if we move to the next slide, we look at the key economic developments in the region, some of them being obviously Iranian sanctions 2.0, the Turkish currency crisis, and the OPEC production cut. Now, if we look at the Iranian sanctions, we see that amid strict U.S. sanctions, companies will stay wary of doing business in Iran, obviously of fear of losing the U.S. market. Even though the U.S. backed off the nuclear deal, the other JCPOA member countries, including the European Union, China, Japan, and Germany, remain committed to the agreement, trying to help companies through a special purpose vehicle for continued trade with Iran in euros and avoid sanctions. Now, looking at the Turkish currency crisis, the economy has probably entered a technical recession in Q4 2018, and the economy is headed to a sharper fall in 2019, close to negative 1%. The industrial production falling sharply. Crude oil imports may be the hardest hit, as liquid fuel is most prominent import product in Turkey, and there appears to be a fewer number of companies now offering crude oil to Turkey. However, Turpos, Turkey's sole refiner, still continues crude importation. Looking at OPEC's oil production cut, the agreement including Russia to cut 1.2 million barrels a day from the collective production in the first 6 months of 2019 actually might not be enough to balance the market and support higher prices given a weak, the weak and politically restless global economy, and also the significant rise in U.S. shale production. We foresee that actually a deeper cut close to 2 million barrels per day is needed through the end of 2019 to help prices rise above the average level of about $50 per barrel. Oil exporters, including Saudi Arabia and the UAE, are likely to cut oil export in 2019, and the Kingdom of Saudi Arabia has already signaled a drop in oil exports by 1 million barrels in January. I'll now hand back to Naya to take us through the rest of the regional outlooks.
Thank you, Craig. So we now come to our last two regions, Europe and Asia Pacific. Beginning with Europe, as you can see on this particular slide, we have the trend lines for Germany and the UK. So as you can see for Germany, the economy saw quite a sharp dip in its 2018 growth. Being an export powerhouse, Germany is particularly exposed to the ongoing trade tensions, and we expect this factor to continue to be a key restraint to the German economy in 2019. Looking at UK, we're expecting growth to slow down marginally to 1.3% in 2019. Now, this is expected to only happen if a transition period unfolds. What this means is that if a deal is signed and ratified between the UK and the EU parliaments and all goes well and a transition period comes into phase, we expect 1.3% growth. If, however, a no-deal scenario comes into place, or that's the worst-case scenario, we're expected to see a much sharper slide in growth to about 0.5%, and we'll delve into the details of Brexit and its implications over the next couple of slides. Moving over to the next slide, we have Italy and France. So as you can see, Italy also saw a sharp dip in its 2018 growth to 0.9%. There was a lot of political turmoil happening with Italy in the light of its standoff with the EU over its 2019 budget deficit. In fact, a couple of weeks back, the growth prospects for Italy were much weaker in the light of the ongoing standoff. We saw the risk of financial sanctions that could have been imposed against Italy, even possibly a debt and financial crisis in Italy that could spread across larger Europe. But now that that's been resolved, the growth prospects for Italy are much better for 2019. Although we are expecting growth to slow down to 0.6% in the light of weaker external demand and higher interest rates. If, however, the budget standoff hadn't been resolved, we'd be seeing a lot weaker growth than 0.6%. France again saw a lot of unrest on its streets in the year 2018, because of which a fuel tax hike for 2019 has been delayed. Not too much of a growth acceleration expected for 2019. We're only expecting to see 1.6% growth. So the general outlook for Europe is one of that of slowdown. And our last country is Russia on the next slide. Russia again is expected to see its growth slow down in the light of factors such as oil production cuts, expected oil production cuts, as well as weaker oil prices and a tax hike that came into effect at the start of this year. So moving over to our next slide that analyzes the key economic developments. Of course, the major one is that of Brexit that has very important ramifications for the UK and Europe at large. So the present state of the situation is that a deal between the UK and the EU have been agreed to, but the UK Parliament shot it down. So over the next couple of weeks, all eyes are obviously going to be looking to see whether this particular deal is ratified. Now, if a Brexit deal is ratified before March 2019 of 2019, a 2-year transition phase will come into effect until December of 2020. What this essentially means during this transition is that trade and business conditions really remain unchanged. So business would really be business as usual in the sense that no tariffs would be applied and customs checks wouldn't happen. And a very important thing is that this transition phase gives businesses that additional time they require to actually prepare and restructure their supply chains for post-Brexit conditions. If, however, over the next couple of weeks we see that a deal is not finalized and not ratified, there are a couple of scenarios that could throw out. Brexit Day is, of course, on March 29th of 2019. There could potentially be an extension of the negotiation period if the EU approves. Another, of course, is the no-deal scenario, and a quick summary of why this scenario would have such a damaging impact on the UK economy is because if the UK leaves the EU with no deal, soon after March of 2019, higher tariffs would come into place, financial firms would lose their passporting rights, customs checks would come into place. So it's a whole restructure of trade and supply chain disruptions that we're expecting to see. Now, on the same topic of trade, a very key important development that we saw in the past couple of days on February of the 1st, of course, was the EU-Japan trade deal that came into force, which is in fact the largest free trade deal. So we're expected to see that this particular trade deal will give EU exporters a huge push over the next couple of years. Now, what does this mean for the UK in particular? For British exporters, what we're expecting is that if UK remains in the transition period, UK exporters will be able to reap the advantages of free trade with Japan. If it's a no-deal scenario, however, what happens is that UK will not be a party to these benefits. And moving on to the other key economic development, of course, is the Italian budget that we've spoken about. It was really a key risk a couple of weeks ago in terms of possible financial sanctions. This has, however, moved over for now, and we're seeing some sort of stabilization in the economy. Moving over to our next section, and our last section, last regional economic analysis for today, in fact, for Asia Pacific. So this particular slide analyzes the two emerging Asian giants, China and India. China, as we're seeing, is experiencing a growth slowdown, but like Arup mentioned, growth is still quite high in the range of around 6% compared to other economies that are growing. So we expect 6.2% growth in 2019. A key risk factor to this growth is the escalation of trade wars. If trade wars intensify, we're expecting growth to slow down to about 5.8%. What we're seeing on the other hand is that the Chinese government is renewing its focus on infrastructure investments in order to shield its economy from slowing growth. Looking at India, India really is quite a bright spot in the global economy. We're expecting growth rates of about 7.2 to 7.3%. Like Arup had mentioned, the demonetization exercise and a new tax regime did slow down growth to about 6.7% early in 2016-17, but we're seeing quite a pickup in the light of factors such as very strong private consumption demand and weaker oil prices this year, of course, are expected to help India, an oil importing country. Moving over to the next slide, we have Japan and Indonesia. Japan again is sort of a case similar to Germany. Being an export powerhouse, the country has been feeling the ripple effects of the trade wars, so it remains quite exposed in 2019. Adding to that are a tax hike that's planned, but the economy is expected to receive some fiscal support that's expected to counter the negative effects of this tax hike. Indonesia, a very large Southeast Asian economy, is expected to register quite strong growth of about 5.1% in the coming year, largely fueled by very strong domestic demand. Moving on to the next slide, which analyzes key economic developments for the region. Of course, the US-China trade wars and its impact for the Asia-Pacific economy. So there are a lot of some positive and some negative effects and impacts that we're seeing. With respect to the Chinese economy, for example, there is a lot of slowdown that's happening, and we are seeing that investors are either delaying investments into China or completely holding off investments into China, given that they could come under these new tariffs. Similarly, countries that supply raw materials to China are also feeling indirect effects. South Korea and a lot of Southeast Asian countries, for example, are feeling the indirect pressures of the trade wars as the Chinese economy slows down. But on the positive side, we are seeing growth opportunities being opened up across countries such as Vietnam and Thailand. In the light of trade wars, investors are increasingly looking at these countries. And the last key economic development is that of capital outflows. So emerging markets at large, especially Asia-Pacific emerging markets, saw a lot of capital outflows taking place in 2018, especially in the light of US interest rate hikes that were drawing back these capital flows. So we saw emerging market central banks sort of going on the defensive and raising their own interest rates in order to shield their economies and their currencies. So right now what we're expecting, especially given that the US is not expected to continue with rate hikes, we're expecting similar steady rates across emerging markets. This could of course change if the US monetary policy direction changes. With that, we come to the end of our regional economic outlook section. I'd like to ask Anna to take us through our poll question for the day.
Thank you, Neha. Yes, audience, I have just pushed out our poll question, which reads, what do you view as the biggest economic threat to your business in 2019? Is it trade wars, Brexit, higher interest rates, lower oil prices, or political turmoil? So we'll leave this poll open, and we will reveal the results at the end of the session. Now, I'd like to go ahead and pass the presentation over to Craig to continue with the key conclusions.
Excellent. Thank you very much, Anna. Now, just to conclude with some of the identified growth opportunities across the various regions. The first thing we deal with is obviously Brexit. There will likely be the enforcement of the Brexit transition to guarantee free movement of workers between the UK and EU until December 2020, with these workers actually then enjoying the right to stay even post-transition. Now, firms in the UK could then prioritize tapping into the EU labour pool during the transition period, given an unexpected, the expected uptick in EU immigration, and with hiring from the EU likely to become more burdensome, after the post-transition period. If you look at the US-CMA trade deal, ratification of this trade deal should lead to higher automotive manufacturing in the US and Canada. This given the requirement for higher regional value creation content for autos, and then with a certain share of content to be generated in high-wage areas. With OEMs expected to restructure the supply chains to meet this requirement, US and Canadian suppliers of parts and components for autos should work with the OEMs to replace restricted supplies from the rest of the world. If we look at Saudi Arabia privatization, more than 20 companies are to be privatized in 2019, with prominent companies including the Saline Water Conversion Corporation and the Ras Al Khair Power and Desalination Plant. And companies can look to tap into investment opportunities across core sectors such as health, education, and desalination with these privatizations. Looking at China's infrastructure, we again see that China is looking to boost infrastructure investments following weaker infrastructure investment in the first half of 2018, and this is to boost the Chinese economy amidst the obvious trade tensions with the US. Private businesses should look to tap into infrastructure investment opportunities across the areas such as energy, transportation, and also with private investment that's been encouraged in the country. Look at the next slide. So lastly, I just want to turn to some of the key takeaways from our briefing. The global economy is expected to enter a period of moderate slowing, as we've said before, with 3.5% growth in 2019. This obviously in contrast to 3.7% in 2018. The growth forecast, as we've heard, could potentially see a further decrease to 3.3% if the trade war does intensify. One of the key risks to the global outlook for 2019 is the uncertainty and the impact of an escalation of the trade war. In 2019, we are likely to see steady interest rates as the US Fed could keep rates steady, and this will obviously spill over to emerging markets who have not reacted to currency speculation and keep their rates steady as well. The trade conditions between the UK and EU should remain largely unchanged if the transition period does run its course. If, however, a no-deal scenario unfolds, there could be major implications and supply chain disruptions. Thank you. I'll now hand quickly back to Anna to take us through the answers to the poll question.
Thank you, Craig. So these are the results. I went ahead and stopped the poll question, and it looks like 50. Okay, so here's the numbers now. They just changed right now. Okay, so 52% indicate trade wars, 21% indicate Brexit, and it looks like 5% indicate lower oil prices, and lastly, 21% indicate political turmoil. So these are the results of the poll question. What do you view as the biggest economic threat to your business in 2019? And just a couple of next steps here, and then we'll start with the Q&A session. So your feedback is very valuable to us. So under the Rate this tab, please provide any feedback, comments, or suggestions on today's presentation. And let's go ahead and get started on our questions. Now, we do have a lot of questions coming through. We're going to try to answer as many possible live. If for some reason we do not get to your question, we will get back with you. So let's go ahead and start with our first question here. Our first question is, however, the American economy is widely believed to be entering a slowdown or even a recession in the near future. The general signals coming out of the markets and the economy itself do not show that. Markets are still active, the job market is strong, and all the indicators seem to show a strong economy. How do you see the situation playing in the U.S.? Is there a chance there will not be a recession, or is it coming for sure in the next 2 to 3 years?
Thank you, Anna, for the question. So our analysis lines up as well in the sense that the U.S. economy did grow very strong in 2018. to a large extent fueled by tax cuts, and the actual data in terms of job growth and all of that was really quite strong. But towards the end of the year, we did see that trade wars started to sort of and other factors started to take a bite of the growth, and we're expecting growth to slow down further in 2019. Now, with respect to the specific question of whether there is a recession coming for the U.S. in the next 2 to 3 years, we don't forecast a recession under our baseline scenario or under the present situation as is. It really depends on how scenarios play out. For example, if it's an all-out trade war, then we could expect growth to obviously dip to a much larger extent. Similarly, if it's an all-out trade war with the combination of a very long and sustained second government shutdown, there's of course much weaker growth that's expected. So it really depends on the scenarios that play out, and if the Fed in fact goes ahead and hikes interest rates, which we don't really see happening at the moment. So it depends on the scenarios that play out. They would really have to be extreme scenarios to pull the U.S. economy into the recession. But right now for 2019, based on current trade talks and based on the way things are going, we don't expect a recession at the moment.
Thank you, Neha. And just as a quick reminder, under the Attachments tab, we have the Global Economic 2019 Outlook. You can click on that, and that will take you directly to the report. And some of the key questions that we'll go through is what is the outlook for the world in 2019, Brexit, trade wars, and the global economic by regions. So that's under your Attachments tab. Now moving on to our next question here. Would you agree that Brazil, Mexico, and Colombia should be the primary investment targets in Latin America for 2019? What are your thoughts on Chile and Peru as investment targets?
Thanks. I'll take that question. If we look obviously at Brazil, we see certain structural issues with output gaps in the economy itself. There's also a little bit of uncertainty in the economy. Unemployment is not it's quite high. There's quite a bit of uncertainty now with the new president facing a little bit of a uphill task to stabilize the economy fiscally. So I wouldn't rate Brazil as one of the highest ones. Colombia, on the other hand, is quite a good performer in Latin America, and we do see quite a bit of investment going into mining activities in Colombia at the moment. There's also been quite a bit of work done fiscal terms in terms of tax reforms, a lot of work by the government. So those are all positive signs, increasing investor confidence in the country itself. But obviously, being a major oil exporter, that has a major impact on obviously GDP in the currency of the economy itself. So that's the downside factor one has to look at. Interestingly enough, if we look at Chile, that's one economy that actually has quite a strong monetary and fiscal policy and a fairly good regime. They've done quite well in past years in terms of GDP growth. And also very interesting to look at Chile in terms of obviously mining. They're very much export-centered economy in terms of mining, as with many of the Latin American and African countries. But their investor confidence, business investor confidence index actually tracks perfectly to copper commodity prices, which is quite interesting for that economy. So if one does see that the outlook for copper, prices are looking upward, then Chile is potentially a country to look at for investment moving forward. Thank you.
And also to add to that, what Craig has said with regards to Chile, Frost & Sullivan also undertakes an annual exercise by which we undertake an indexing-based approach to sort of identify the go-to emerging markets for each year. And one of the Chile, in fact, came out at the top for the Latin American region. It was #1. So we are having another live webinar on our emerging market index soon. So be really happy if you could dial in for the same. It should give you a better understanding of which markets you should be looking at emerging markets you should be looking at in 2019.
Thank you, Neha. Thank you, Craig. Also, I've displayed some contact details for Vignesh. Vignesh is our key account manager, and if you would like access to a copy of the Frost & Sullivan's 2019 Economic Outlook Report, also, we are working on some exciting research on hot economic topics such as Brexit and trade wars. Please, if you want to learn more about the research or engage in a growth strategy dialogue, please do get in touch with Vignesh. His direct telephone number is listed on the slide along with his email address. And with that, I'm going to conclude today's session. I want to thank everyone for joining us today. Thank you, Ruth. Thank you, Neha. Thank you, Craig. And again, please contact us with any questions or additional feedback. Thank you for your time.